Hello, my dear students. Lucas Commerce Academy, the power of accounting welcomes you. Today, let us start a new chapter depreciation. Depreciation. Generally, every organization uses two types of assets. Number one, current assets. Number two, fixed assets. Current assets means the assets which are converted into cash within a period of one accounting cycle. The examples for current assets are cash in hand, cash at bank, debtors, bills receivable, closing stock, outstanding incomes, etc. So these are the examples of current assets. At present, we need not current assets. Then we are going to discuss number two, fixed assets. Fixed assets means the assets which are purchased for the purpose of long-term use in the business. So these assets are used in the business for the purpose of production of goods and services. When these assets are used in the business for a long period or long time, they gradually decrease their value. Such a decreased value is known as depreciation. That means the decreased value in fixed asset is known as depreciation. The decreased value in fixed asset is known as depreciation. For example, a firm purchases a machinery for rupees 1 lakh and uses it for 1 year. Suppose at the end of the first year, the asset value say 90,000. So here 10,000 value is decreased. That 10,000 decreased value is known as depreciation. Okay. So let me give you one definition for depreciation. Depreciation means it is a permanent and gradual decrease in the value of asset due to use is known as depreciation. So depreciation means the permanent and gradual decrease in the value of fixed asset due to use is known as depreciation. Okay. So there are some methods for calculation of depreciation. The important methods are number one, fixed installment method or straight line method or original cost method or equal installment method. Number two, diminishing balance method or written down value method or reducing balance method. Number three, annuity method. Number four, sinking fund method or depreciation fund method. Number five, insurance policy method. Number six, revaluation method. Number seven, depletion or output method. Number eight, machine hour rate method. Number nine, sum of digits method. Number 10, mileage method. Number 11, kilometers method. So these are the methods for providing depreciation. So let us discuss one by one. The first one is fixed installment method. Under this method, the amount of depreciation is constant, is fixed for each and every year till the end of the life of the asset. Under this method, the amount of depreciation is constant, is fixed for each and every year till the end of the life of the asset. Okay. So under this method, how to calculate depreciation? There are two formulas we are using for calculation of annual depreciation. The first one is when the rate of depreciation given in the problem, in that case, how to calculate annual depreciation. So annual depreciation equal to cost of asset into rate of depreciation by 100. For example, cost of asset 1 lakh into 10%, 10 by 100 equal to 10,000. So that means depreciation for first year 10,000, second year 10,000, third year 10,000, fourth year 10,000, fifth year 10,000, sixth year 10,000, seventh year 10,000, eighth year 10,000, ninth year 10,000, and 10th year 10,000. So that means 10,000 into 10, 1 lakh. So depreciation 1 lakh, cost of asset is also 1 lakh. That means at the end of the life of the asset value becomes 0. So at the beginning of 11th year, we have to purchase another asset for the purpose of business. So this is the first formula. So once again, annual depreciation equal to cost of asset into rate of depreciation by 100, 1 lakh into 10 by 100, 10,000. Next, another formula is there. So when the rate of depreciation is not given, then use this formula. So the annual depreciation equal to formula, annual depreciation equal to cost of asset minus scrap value by estimated life of the asset. So what is the meaning of cost of asset? Cost of asset means not only the original purchase price, but also transportation charges incurred from the place of purchase to the place of our business, erection and installation charges also taken into account. So that means cost of asset equal to purchase price plus transportation charges plus installation charges. Brokerage or commission, if any, paid on purchase of asset, that brokerage or commission also part of cost of asset. Okay. So this is the meaning of cost of asset minus scrap value. Scrap value means the value which is realized at the end of the life of the asset as scrap by estimated life. So estimated life means the number of years used in the business for the purpose of production. Okay, got it. So now under fixed installment method, there are two formulas for calculation of depreciation. Annual depreciation equal to cost of asset into rate of depreciation by 100. Say cost of asset 1 lakh into 10% equal to 10,000. This is annual depreciation. Next, another formula. Annual depreciation equal to cost of asset minus scrap value by estimated life. Estimated life of the asset. So cost of asset say 1 lakh. The scrap value 10,000. This value will be realized at the end of the life of the asset. Then the original cost is 90,000. Okay. By estimated life of the asset take 10 years. Here 90,000 by 10 equal to 9,000. So here annual depreciation 9,000, there 10,000. So in this method, the amount of depreciation for each and every year 10,000. Here the amount of depreciation for each and every year 9,000. You see, 9,000 into 10 years equal to 90,000. But cost of asset 1 lakh. So the difference is scrap value. This is the scrap value. The value which is realized at the end of the life of the asset. The actual depreciation 90,000. we are going to realize 10,000 at the end of the life of the asset. Then the total asset value 1 lakh. Okay. So in next class, we are going to discuss how to pass journal entries under this method and how to do the problems. So let us discuss in next video. Till then, thank you. Thank you very much.